Hi, everyone, and welcome to Finance Concepts by your Finance-ista, Cynthia Bush. I'm going to focus today's session on IPO costs. And specifically, I'm going to talk in more detail about the spread, which is the biggest component of direct costs. I'm also going to talk about other direct costs, and I'm going to talk about indirect costs. And if you are unfamiliar with an IPO, please see my video on IPOs. So let's look at other direct costs first. These are costs that must be paid by the company who is going to be doing the IPO. They include such things like legal fees, accounting fees, regulatory charges, listing fees, and taxes. All of these other direct costs must be disclosed in the prospectus. This shows you some examples of pre-IPO direct costs incurred by companies getting ready to do an IPO. Now let's look at indirect costs. These are incurred by the issuing company. They include extra expenses that the company encounters as it prepares itself for an IPO. So you have such things as new organizational structures that may be appropriate so that the company is more in keeping with what the public market investors would anticipate. It also will include the amount of time that management needs to devote to the IPO process, thereby being unable to spend that time on other areas and activities within the company. These types of costs, these indirect costs, are not disclosed in the prospectus. Some examples of indirect costs are also things such as if the company needs to reconstitute its board of directors, perhaps creating an audit committee, making sure its financial statements are in the appropriate format and are audited on an annual basis, potentially looking at reevaluating its compensation structure, etc. Now I'm going to spend the bulk of the time talking about the underwriting spread. An underwriting spread is incurred when a company decides to do an underwritten IPO. For the other types of IPOs, please see my video on IPOs. So in an underwritten IPO, an investment bank or banks agrees to buy the securities that are going to be sold from the company, and then is going to turn around and resell them to the public at hopefully a higher price. This is how the company pays the investment bank or banks for its services. I like this explanation by Investopedia about how the spread is calculated. It is essentially the difference between what the investment banks receive when they turn around and resell the securities to the public, minus what it paid for them when it paid the company for the securities directly initially. Usually the underwriting spread is quoted as a percentage, and typically the percentage ranges from about 3% to about 7%. It really depends on such things as what is the total deal size, what industry is the company in, what is the type of demand expected for the shares, how well known is the company's product or services, etc., etc. Note that of all the direct expenses, the underwriting spread is by far the largest. So now let's turn to an example. Digger Company decides to do an underwritten IPO to raise $20.2 million to finance its Asian expansion. The offer price has been determined to be $28 per share. Accounting, legal fees, taxes are all expected to be $755,000, and the company's investment bank is charging a spread of 7.3%. So let's determine how many shares need to be sold for this IPO. Step one is, let's calculate the total amount of money that should be raised so that the company can cover all of its direct expenses and still have $20.1 million left That's what it needs to finance its Asian expansion. So we take the amount that the company needs, $20.2 million. We add to that the direct expenses of $755,000, and we divide by 1 minus the spread percentage, in this example, 7.3%. So that determines that the company should raise $22,605,178. Now let's calculate how many shares should be sold. Well, take the amount that should be raised, divide it by the expected offer price of $28, and you get 807,328 shares that should be sold. Okay, now let's take the same example, but let's answer a different question. And the question is, what is the underwriter spread in dollars? It is most frequently expressed as a percentage, but you can calculate the dollar amount. So step 1 is the same as in the previous example. We calculate the total amount that should be raised to cover all the direct expenses. Then we calculate how many shares should be sold, which is step 2. And now we can calculate the dollar amount of the spread. Take the total amount that's going to be raised times the spread in a percentage and divide that by the number of shares to be sold. And when you do the math, you get $2.04 per share. So in other words, when the underwriters buy the shares from the company and then turn around and resell them to the public at $28, the difference between those two is $2.04 per share. So the underwriter spread in dollars is $2.04. Notice that if you took the $2.04 and you divide it by the offer price of $28 per share, you get the underwriting spread in percent, which is 7.3%. Okay, let's look at a different example. Greg's Gelato Company just completed their underwritten IPO. The company received $20.05 for each of the 3.6 million shares sold. The initial offering price was $21.75 per share, and the stock rose to $28.56 per share in the first hour of trading. Greg's Gelato Company paid $966,000 in legal fees and other direct costs, and the company estimates $217,352 in indirect costs. So let's answer this question. What is the company's flotation cost as a percentage of the amount received by the company? Step 1, let's determine how much the company received. So the total amount raised in the IPO was $21.75 per share, that's the offer price, times 3.6 million shares sold. You get $78.3 million. But that's not actually what the company got. Don't forget, they need to pay the underwriting spread. The underwriting spread is the difference between the initial offer price and the price that the company received times the number of shares that was sold. So we take $21.75 minus $20.05 times the 3.6 million shares sold, and we get 6.12 million. That's the spread that's going to the underwriters. Then we have other direct costs that must be paid of $966,000, and the company has estimated about $217,352 in indirect costs, excluding the underpricing, which I'll explain in a bit. So you can add up all the flotation costs, excluding the underpricing, and you get $7,303,352. When you subtract that by the total amount raised in the IPO, the net amount that the company receives is $70,996,648. Notice that of the flotation costs, the underwriting spread is the largest component of these expenses. Please also note that if you do this on your own and you get slightly different numbers, it will be due to rounding, as I have rounded all numbers in this example. Okay, so now let's do step 2. In step 2, again, we are subtotaling our direct costs, including the underwriter spread, and that's how you get $7,086,000. Now let's go and look at the indirect costs. We have the indirect costs that the company estimated of $217,352. But there is also the indirect costs in terms of the amount of money the company lost out on or missed out on by underpricing the shares relative to market demand. Within the very first hour of trading, the shares rose to $28.56. So if we take $28.56, we subtract that from the actual initial offering price of $21.75, and we multiply that by 3.6 million shares, that is the value of underpricing the shares relative to market demand. And when you do the math, you get 24,516,000. So if we add the indirect costs of 217,352 plus the indirect costs of the underpricing, your total indirect costs are 24,733,352. And when we add that to our total direct cost, that's the company's total flotation cost for this new issuance, $31,819,352. So to answer the question about what is the company's flotation cost as a percent of the amount received by the company, we take the total flotation cost and we are including the underpricing in the total flotation cost. So again, that was the $31,819,352. And we divide that by the amount received by the company of $70,966,648. And so total flotation costs are 44.82% of the amount raised and received by the company. Notice that we can also calculate the underwriter spread as a percentage, which is how it's typically expressed. So for the exact same problem, to calculate the underwriter spread, take the initial offering price of $21.75, subtract what the underwriters paid the company, which was $20.05 per share, and then divide that by the initial offering price, and you get an underwriter spread of 7.8%, which is how it is most commonly expressed. All right, thank you very much. That's all for now. Until next time, this is your Finance-ista, Cynthia Bush. I am signing off, but please don't forget to subscribe to my YouTube channel.